We'll look at a question to buttress how marginal costing and assumption costing technique works. Using this technique to prepare your income statement. If you have not watched the previous video, how it was introduction, you can watch that to get other understanding before we proceed with this. However, we'll solve this question to show how it works. Marginal costing and assumption costing technique. The following information relates to a company. We are given their per unit selling price on the left, the direct material cost, variable overhead, and the direct wages. For the year, we are given the fixed production overhead cost 9,000, fixed selling expenses 14,000, fixed administrative expenses 26,000. Other informations available, we are told variable selling expense are 10% of sales value. Normal capacity is 11,000 units per year. Production and sales for 2001 and 2002 are as follows. Sales for 2001 and their production were given also for 2002. You are required to prepare a profit statement for each of the year using the marginal costing technique and assumption costing technique. Reconcile the profit between marginal and assumption costing for each year. That will be part of the question. I'm going to solve the one for 2001 and as an assignment for you to solve the one of 2002. If you have any question, you can as well call. You can as well send a message in the comment section. However, we'll look at this. You can always go back to pause and read the question and go back again as the solving continues. So we look at this question for us. Okay, we start with the marginal costing. We start with the marginal costing. Sorry, I need to change this pen. Look at the marginal costing and cost statements. So, like I said in the previous video, we check the previous video, just to reiterate something before we start. If you remember your P&L account, or what you call your income statement in your financial accounting, it usually starts with sales, less cost of sales. So this cost of sales, is made up of opening stock, purchases, add purchases, then less closing stock. So these are basically the three things that make up your cost of sales. So the difference here in performance management is that you're dealing with a manufacturing company. So they don't purchase what they sell. Rather, what they do is that they produce what they not sell. So you see the difference. You produce what you sell. So we'll bring out production cost. Like I said, the previous video, if you go to the previous video, you can pause and see the write-ups. We mentioned that for marginal costing, all these items here are stocks and they are valued using your variable cost. But if it is absorption costing technique, all these items will be valued using their total cost of production, which involves both the variable cost of production and the fixed cost of production. So this is how it works. So therefore, we'll go back to solve the question. This is all you need to know. So if you already know this, it's all about you going back to solve the question. So let's just clean up this. So we'll start marginal costing and cost statements. We'll start with the sales. We are told that in the question, you will see that we're for that 2001. Remember this for 2001. So you will do 2002. In 2001, we are told that 10,000 units were sold. And the selling price was 50 naira. So this will give us 500,000. Less variable costs. Now, you can also call it less variable cost of goods sold. But if you leave it as less variable cost, so opening stock In this question, there's no opening stock. Add purchases. So instead of adding purchases, like I said, rather you'll now say add production cost because we produce what we sell. We no longer purchase. How many units we are produced? In the question, we are told 12,000 units were produced in 2001. And this will be valued using your variable cost because you can see it is less it's under less your variable cost. So it's under a variable cost, which means it's a variable cost we use in valuing it. So what is the variable cost? If we go to the question, we do some workings. We are told that variable costs, we are given several variable costs. Let's add it up. If we add up all the variable costs given, we will arrive at 25 naira, yes, which is addition of 18, 3, and 4. Variable cost is equals to 18 for the direct material. Let's spell it out for the sake of the study. So we see we have direct material, 18, variable production overhead, 3, and direct wages, which leads to direct labor. And we are told it's 4. Yes, 4. Add all together, give us 25. So therefore, we'll value using 25, this stock of 12,000 naira. So 25, if you multiply by that, you will have 300,000. Now let's close in stock. We produce 12,000. From the question, we produce 12,000. This year, produce 12,000. But we sold only 10,000. So we have 2,000 as closing stock. This 1,000 as closing stock, obviously, will now go to next year as opening stock. So this 2,000 will value it using 25 naira too. At 25 naira times 2,000 will give us 50,000. It will also have another additional, because we are saying less variable costs, we have also other variable costs, which we are told that selling expenses of 10%, variable selling expense. So we consider that a selling expense is a variable cost. And we are told it is 10% of sales times sales. Sales is 500,000. So 10% of sales is 500,000 is 50. So remember, this is 300,000 minus, that is production costs less closing stock. Then we add the selling expense, which is giving us the total of 300,000. We deduct all this 300,000 from your sales, it gives us 200,000. This is what you call contribution. Notice contribution is usually sales minus variable cost. So what it means is that sales minus variable cost will give us contribution. The next thing is to less our fixed cost. What are the fixed costs in this question? We were told we have a fixed cost called production overhead, 99,000. We also have selling and distribution. I want me to write it like this. Selling and distribution, 14,000. Admin overhead, 26,000. Total 139. So you deduct this all your fixed costs. These are all your fixed costs from your contribution of 200,000. You have your profits, 61,000. This is how to use the marginal costing technique to prepare cost statement. We'll look at the absorption costing. Still for the year 2001. We prepare the same income statement. So we have sales. Sales have not changed. We still sold 10,000 units for 15 naira each, giving us 500,000. Less variable costs. No, sorry, this is absorption costing. So it will now become less cost of goods sold or cost of sales. Your cost of sales is made up of opening stock. Opening stock, there's no opening stock in this question. So dash add production cost. Total amount produced was 12,000 units. Multiply by. So now what is the full cost? Like we said in the previous note, that's just like we did here in the marginal costing technique. All these costs, opening stock, production, they are all stock, and closing stock. These three items we value them using a variable cost. That's why we say less variable cost. And when it comes to absorption costing, we'll value these same three items using your full cost of production, which means both your variable cost of production and fixed cost of production. So what is the fixed cost of production? In the question, we're only given one fixed production cost, which they say was 99,000. So fixed overhead was 99,000. So to get the cost per unit, it will be 99,000 divided by 11,000 units. Let's put this in order here. Fixed production overhead, we are told is 99,000. And we are told that the projected activity level, they call it normal activity level of the company, is 11,000. So therefore, this divide will give us 9. If you read the notes in the previous video, which has to do with marginal costing and absorption costing part 1, you will find out that this is the same thing as here, overhead assumption rate or the overhead recovery rate, which is calculated as projected overhead divided by projected activity. So in this case, we are not giving any projected overhead, so we assume the actual overhead was the same as what they projected, which is 99,000, and the projected activity is 11,000, which is their normal activity level. So to get our full cost, we add the 9 naira to the variable cost of 25 naira. So that will give us total cost of production per unit to be variable cost of 25 plus the fixed of 9 naira. Remember, I did not consider other fixed costs. Notice I did not consider, there are 3 fixed costs here. You can see 3 fixed costs here. I did not consider them. I only considered production overhead because that is the one relating to production. So you don't consider selling and distribution, they don't relate to production. So it's only the fixed production overhead that will be added to the variable production overhead. So all the direct material, variable production overhead, and direct wages, they are all part of production. So that's why they are used to value the stock. So if we add these two together, what we get is 34 naira. So we come back to our income statement. We'll value this production cost using 34. That will give us a total value of 408,000. 48,000. Less closing stock. Less closing stock. Closing stock is giving us 2,000. Remember, we produced 12,000 units, but we sold only 10. So we have 2,000 outstanding. They will also be valued at 34. So if I multiply this, I'll get 68. 68,000. If we less this, it will give us the total cost of sales will be 340. Less this from your sales, you will have 160,000. This is called gross profit. This is what you do normally in your financial accounting, gross profit. Now less other expenses. So what are the other expenses? We have selling and distribution. Okay, we have again, sorry, we have first of all a variable expense, which are not treated, variable selling expense. So every other expense coming now, which is 10% of sales. 10% of sales, according to the question, times sales is still 500,000. So this will be 50,000. We have also selling and distribution. And the distribution expense, 14,000. We have admin expense as 26,000. This is a total of 90,000 naira. The next thing to be treated before we are done with this is to check if to treat over or under absorbed overhead. To check if overhead was over absorbed or under absorbed. And to do that, we check overhead. Let's do some working here. For you to know whether overhead, we call it under or over absorbed overhead. Look over. You first of all compare. For you to get that, we say we compare your absorbed fixed production overhead. The absorbed fixed production overhead with you compare this and actual fixed production overhead. The difference will give you what we will call whether overhead was over-absorbed or under-absorbed. Absorbed fixed production overhead is calculated by saying, so let's put a space here so that we can, let's put a space here. So I'll show computation of the fixed overhead, absorbed fixed overhead. So it is calculated by saying what is the actual activity. In the question, the actual activity, that's what was actually produced in 2001, is 12,000 units was produced. So check also our previous video, you see this. I took time to explain that. So 12,000 times, which is actual activity, times overhead absorption rate, which we have calculated here as 9 naira. We told this overhead absorption rate is predetermined. That's why it is calculated using budgets. That's why it's calculated like this. We use budgeted overhead divided by budget activity. So it's based on budget. It's predetermined. So when we do this, we get a value of 108,000. Then we compare this with the actual fixed overhead, fixed production overhead. So the actual fixed production overhead in this question, we're told is 99,000. Find the difference, we get 9,000. So absorbed is 108. It's higher than the actual. So you say overhead was over absorbed. Over absorbed overhead is treated as a cost. It's treated as a cost, so it's treated as a deduction. So the idea I give my students on how to remember easily is to say, if something is over, it's like saying it's too much, you should reduce it. So over absorbed overhead, deduct it. Over absorbed overhead is 9,000 naira. You deduct it from costs. So I'm treating it against cost. This 90,000 naira is a cost. Since I'm treating it against cost, and it's also a cost, I will reduce. If I was treating it against profits, if I was treating it against this 160,000 direct, this 160,000 gross profit, I will add. So what we said is over absorbed overhead is either deducted from cost or is added to profit. So but here I'm treating it as a deduction from. So 90,000 minus 9,000, I have 81,000. That gives me my profit, 79. So you are expected, some other persons might decide not to treat it like you have done it. Over absorbed overhead, they can decide to say, deduct all your expenses, you arrive at profit, then you now treat it against that profit, final profit. If you do that way, that means you will have to add. Here we have to deduct. So the rule is that over absorbed overhead, the rule is that over absorbed overhead is treated as addition, add to cost or deduct from profits. Whereas under absorbed overhead is treated as a deduction from cost, deduct from cost, or add to profits. Deduct from cost, add to profits. So when you have to do the prepare, you are expected to do for the year 2002. I have done the one of 2001, which is the marginal cost, the A part of the question. I've prepared using my marginal cost. So you do that of 2002. The only difference is that when it comes to your opening stock, your closing stock in 2001 will become your opening stock in 2002. And in 2002, remember in 2002, 10,000 units were produced. That's production. But we are told that the sales was 12,000. Is that possible? How can you produce 12,000 and now you sell more than what you produce? So the additional 2,000 was because of the carry forward from 2001 that came to 2002, making it 12,000. So therefore, there will be no closing stock in 2002. So prepare that of 2002. If you have a question, you can ask. The next part of this question is to reconcile the profits, reconciliation of profits. That will come in the next video. How to reconcile the profit between, you can see the profit between marginal costing. The profit for marginal costing is 61,000 using the marginal costing technique, 61,000. But using the absorption costing, we got 79. You are expected to reconcile this profit. What is causing the difference? And like we said, what is causing the difference is the valuation of stock, your closing and opening stock. So let's look at that, how to reconcile profit between your marginal costing and absorption costing